This is a death cycle that grabs traders, it sucks them in, spits them out, and leaves them very confused, very sad, and on the verge of quitting. But it doesn't have to be this way. So in this video, we will talk about mistakes and psychology that rips off 90% of traders. We all want to win, and it's very easy to kind of avoid or to numb ourselves or to not really pay attention to the drawdown, not pay attention to the times where the market is being very unfavorable. But what ends up happening is typically when the market is being favorable and things are going well and trading feels a bit effortless, we all experience this. Those times somewhat take care of themselves. Not to say that we can't do things to take more advantage of those, but typically nothing really bad happens during those times. So the cycle that I'm talking about goes like this. The market ends up being very favorable, the conditions are favorable, and during this time it's easy to feel like we have cracked the code of trading. Feels like we got this thing figured out, like we made it. So we are noticing a really interesting cycle of institutional inflow, holding elections, and many more. It's like a generational opportunity, but the bull run will be different from others. You need to prepare, not about risk, trading, and be in the context of the news. If you want to save time and money, check out our free Telegram channel where everything listed is posted every day. Let's continue. When that happens, it's easy to get hyped up on euphoria and start letting ourselves trade a bit sloppy, and we're not really getting punished for it. But the market is cyclical, and the market goes through several different conditions, kind of constantly going and out of different conditions. Inevitably, the market is going to turn into a condition that is not favorable for us, for the way that we trade, for the method that we are using, for our style. The action and the behavior of the market is not favorable. We all experience these times where it all feels like we can't do anything right, and it almost feels like the market is personally out to get us. Like if we try to do something, it immediately fails, or it's going to shake us out before it works out, or we're going to see an idea, but it's not going to give us any type of entry. The issue is that you and I cannot impose our will on the market. In a lot of other areas of our life, we can't. If we are not happy with something, anytime that we want, we can start to turn that ship around. If you're starting to get off track with your health and you're skipping workouts and you're not eating clean and you're starting to gain weight and not feel good about your body, anytime that you want, you can ride that ship, start eating clean, start doing the right actions, and start seeing some results from it. But when it's sometimes to the market, there are a lot of forces at play, a lot of participants that are going on, and a large portion of our results we're not in control of in the way to where we can decide that, oh, we've been going through some losing days, today I'm going to turn it around and really crush it today. These decisions are a little bit out of us. The market gives and the market takes away. This is the dynamic that ends up happening when the market is during these favorable times where we should be hitting the gas, we're beat up, and so we are kind of limping along. As the market is being really favorable, there are a lot of opportunities and we could be really pushing things, but instead, we're kind of slowly building back our confidence, slowly starting to build back some of our P&L. And then we got to this place where we are starting to feel confident again. We're starting to maybe use more size, starting to feel like we got a handle back on this right in time as the market changes conditions again. And then we get hacked. And then we start the cycle all over again. Of course, the right side of this dynamic to get on is to be able to understand when this market are turning unfavorably and to be able to throttle back and to survive and to kind of just get through those times so that when the market is favorable, we're pushing the gas and we're really taking advantage of it. So let's talk about that downward part of this cycle, because like I said, in a lot of cases when things are going good, at some level they kind of take care of themselves. But when things are going bad and we're in a period of drawdown where the market is being unfavorable, this will not take care of itself and very bad things can happen here. I think it would be important to understand that when we're going through these periods of drawdowns or when the market is being unfavorable, this can really happen for two reasons. Personally, you're doing something that gets your head out of the game and makes it to where you can't perform right. Trading is a performance endeavor, and no matter what the market's doing, you and I have to be in a position to do this 5 days a week all year around. A lot of things can happen throughout the year that can get us off the screens. This should be recognized that this happens, and we want to be in tune with this and be aware of it. For your method, for the way that you approach the market, for the way that you trade, there are going to be times that are more clear to you and things that are more favorable for you. I think it's easy to come into trading and think that if we learn a method, then this solves all of our problems. The purpose of having a method and a way to approach the market is not so that every single time we sit down to the screens, every single day, we can cross the market. Because now we know this method, we're always going to know what's happening. When you have a method, the purpose of that is so that you have a way of making sense and that you have a way of identifying edge and being able to exploit it when that surfaces. And then every method is going to go through periods of time where there is not a lot setting up, where it's not being very favorable. These are things that we don't have quite a bit of control over, of course. Now, part of the trick here is to identify these as quickly as possible. There are times where things are going off of the rails, and it's not that helpful when we have blown out and when we're starting to hit rock bottom and we're already crushed mentally. It's not that helpful to understand I'm going through a period of drawdown, things aren't going well, and so we want to be able to, as close to real time as possible, start to understand when this is happening. One of the really nice ways to do this is to start looking for patterns, repeatable type patterns of when we are likely to go through drawdown. What we can do is identify repeatable type patterns, so times of the day, times of the week, times around news events, times of the year where we tend to not perform well and are more likely to be in an unfavorable condition. Identifying this is a huge step in being able to handle it, ensuring we're aware of what's going on and moving a certain way. When I started drawing those distinctions and connecting those dots, like the Monday and Tuesday leading to FOMC, I realized I'm getting crushed. The realization is very powerful because now I always throttle things back and am always very cautious during those days. These are changes I've made based on those observations. Another really important thing is having a process for reflecting and monitoring certain KPIs. Think about this is your trading. Is there any kind of process that you go through for monitoring qualitatively how your trading is going and how you are performing? On the KPI side of things, can you track certain metrics to understand how your trading is going and if certain things are starting to dip? Ask yourself if you have any process in place to monitor these things. This is how you catch when things are going off the rails before they completely fall apart. If the topic interests you, let me know. I would love to make a video on the qualitative and quantitative metrics we can look at to monitor our trades and make real-time adjustments. If you want to have more clear pieces of advice of strategies, check out our free Telegram channel where we teach, show strategies, talk about news, predictions, and so much else. We wish to have this at our time. Let's move on. Being able to catch these issues quickly is important. There are things we can do to identify and be prepared for this. Understand if the issue is due to something personal. Do I need to get my act together, refocus, and get back into it? Or am I doing everything right, but the market is being very unfavorable right now? When we're in these periods of drawdown for whatever reason, it's crucial to throttle back. This is extremely hard because it's not intuitive. We don't want to scale back if something isn't going right. We want to be more aggressive. However, it's the opposite for the reasons stated earlier. We can't decide to crush the market. A lot of it is outside of our control. Scaling back using smaller sizes is a good place to start. Another way to throttle back is to focus on our highest quality trades. All of us have a spectrum of trades, from lower quality ones to higher quality ones. When the market is unfavorable, we should focus on our bread and butter trades, those that we do the best, that offer the best risk to reward, and that we understand well. If those aren't setting up, just sit on your hands. If they are setting up, focus on taking advantage of them. Especially early on, when you haven't gone through the cycle enough, it's easy to feel lost and confused when the market is unfavorable. Often it's an unfavorable condition and nothing lasts forever. The market will change conditions again. You will gain clarity again and your edge will return, assuming it's genuinely there. Everybody came from this and become stronger than ever. Write what you think, guys, in the comments, and see you in the next video. Don't forget to share this video, like and subscribe, and see you next time. Michael was with you. Bye.